Here with MAJ Realtors. Thank you for joining us live today. We are doing our very first Ask an Expert, and so we have Fairmars with us from Commerce Bank. So I'm hoping this goes well. We're excited to be talking to Fairmars about what's happening in the market and the mortgage industry considering Covid-19. So he's going to join us soon. We do have someone lined up for next week, so hopefully you'll tune in weekly with us. Next week it's with Christina Artemis. She has Christina Artemis Organizing. So while we're all stuck at home, she'll give some tips on how to organize your lives and your homes. So let's add Fairmar in now. So he'll be joining us, and there he is. Hey, Fairmar. Can't hear you.
Can you hear me okay?
Yeah, I got you now.
Fantastic.
How are you?
Live on Alyssa TV.
Yeah. Thank you for doing this with us. I know I threw it at you earlier this week, or earlier last week maybe, and you jumped right on, so thank you.
The days and weeks are blurring together. It's all good.
It is.
Talking mortgage, so this is great.
Yeah. So we wanted to talk a little bit about what's happened in the mortgage industry since COVID-19 and shelter in place. I know it's been a wild ride, but maybe the public doesn't quite know exactly all the changes that have happened, as well as obviously we do.
Thanks for having me on. It has been a wild ride, and in a lot of ways it's similar to the financial crisis. Some ways better, some ways worse. I've been talking with a lot of folks in real estate and with borrowers who have been on this roller coaster ride. So a couple of things came together that really kind of created this current tightness that we see in mortgage. So it's important to understand that the mortgage business is really a multi-layered business. It's not as simple as just going to one entity and borrowing money. So you've got investors who provide money. We've got short-term money, warehouse lending, we call it, that funds the loans. We've got the servicing industry, which collects monthly payments. And we've got mortgage industry, the originators who are responsible for underwriting the loans. All of these areas are under severe pressure right now. And it really started before when it was in China and we saw stocks falling on the concerns of what was happening there. Rates went to all-time lows. So the last week of February, the first week of March, more loans were originated than ever before. So that put a lot of stress on the system. More money than ever before was needed to fund loans, to lock loans, to all this. So there was a lot of pressure already. And then when stocks dropped the week of March 9th, they took bonds down with them. Normally when stocks go down, rates go down. So we were, Friday, March 6th, we were at 3%. We thought we were headed for 2.5% as stocks were falling, but things all of a sudden went the other way. No one could really figure out what was happening. And all of a sudden we realized everybody's leaving everything. They're going to cash in stocks. They're going to cash in bonds. And so the following week, the Federal Reserve came in and not only did they cut rates to zero, which has allowed banks to borrow at the Fed window at 0%, but that really just helps their liquidity. It doesn't really impact mortgage rates. But they did say they're going to participate as a form of liquidity in the bond market where nobody wanted to loan anymore. And the reason that institutional investors are running away from mortgage-backed securities is that there's a big concern right now about unemployment. So people aren't really sure. I'm loaning you money to buy a house. Are you going to have your job in 2 weeks, 3 weeks, a month, or not? So there's a lot of fear there. But the Federal Reserve stepped in on the conforming level. So we've seen that gap not really get filled on the jumbo front, where institutional investors are still not there, and the Fed is not participating as a buyer in the jumbo market. So normally, in situations like this, we would send our jumbo folks back to the banks and say, okay, you're going to have to go to Wells, Chase. But at the same time, perfect storm, the stimulus package passed, and now they've got to lend $350 billion of PPP loans to support the economy, and they don't have the capital reserves to do all this lending all at the same time. So the jumbo real estate market is really tightened up.
Fairmars, can I jump in a second?
Yeah.
Can you explain to the average person what you mean by jumbo?
Yeah, great question. So in our area, Bay Area, so the national conforming loan limit is $510,000. So that's based on median prices throughout the country. Fannie and Freddie set that every year. So for 2020, it's 510. In high cost areas like the Bay Area, we can go up to 765,000. So loans up to 765 are pretty safe right now, and are we're doing those, and we feel really lucky. Our platform's really digital. We can originate loans. There's not a real drop off in performance there. But loans above 765,000, they're really, really challenging to do right now. And so what we're doing as a solution is for folks who want to borrow, let's say 800,000 or 900,000, we're doing that 765 first, simultaneously with a home equity line. So we're putting two loans together, because when the Fed took rates to zero, they dragged home equity lines down with them. So we can get a 3.5% first and a 3.7% equity line. So your combination there is still really good.
Wow. Okay.
That's a lot for one quick question, huh?
That's a lot for one quick question, and it's 5, so people are probably juggling a lot. So what if you had a crystal ball? And I know none of us do, but what do you think will happen going forward, or what metrics are you following to kind of get a gauge for where things are going?
Yeah, well, this is my first pandemic, so I'm not sure what's going to happen.
Right.
But what we think is going to happen is that. So this is where it's a little bit better than the stress on the mortgage industry is harder than '08. But the better thing is that all of that money that's been pulled off the table, it still exists, right? So unlike 2008, where we saw Washington Mutual, Countrywide, World Savings, these companies just disappeared. They just weren't there anymore, right? So that's not what's happened here. And what we've seen is just a pullback. The big question right now is what happens with employment. So I think as we start to go through these various weeks, maybe months, and figure out, okay, we're at the end of the new unemployment based on COVID, and whoever's left is safe, right? So we've lost a lot of jobs. There's a lot of pain out there, but at least who we're underwriting now, we know has survived it, and they're a good credit-worthy borrower. I think we'll start to see that institutional money start to return to jumbo. So I think I don't know if it takes weeks or months, but I think we'll start to see that calm down. I think rates will stay low for the foreseeable future. The Fed's going to make sure, but they've promised unlimited liquidity. I could see potentially some guidelines tightening up like they did in '08, '09 with regard to underwriting, maybe debt to income ratios, things like that. Definite concerns around, credit quality, we call it. There's a flight to quality. So you're starting to see people with great scenarios get way better rates, and people with not as good scenarios get higher rates or not be able to get a loan.
Okay. So talking about unemployment and people losing their jobs, it's kind of a good segue into the mortgage forbearance question that we're getting a lot right now. So kind of what's your take on that?
So this is a classic situation where legislation versus what actually happens in the real world isn't matching up perfectly. So it's easy enough to pass legislation that says, okay, if you've lost, we want to help the economy, we want to help people get through this. It's very well intentioned. If you are affected by COVID, you have a government-backed loan. That's key. A lot of people don't have government-backed loans, especially in our area, who had to get jumbo loans. So you might not necessarily fall into that CARES package category. Now, there are certain institutions, one by one, like Chase or B of A, who might say that they allow this, but you got to really call your servicer. But what's missing in this is that the intent was that you can skip your payments and not have a credit hit, right? But the question is now, with the servicer, what happens to those payments? So in some scenarios, people are taking 3 months off, but they're going to have to pay 4 months worth of mortgage at the end of those 3 months, which is not really a picnic, right? So, I mean, adding that all up, just, once you go back to work, it's not like you're going to get all of your back pay instantly, right? And not in all cases. In some cases, they're adding those payments to the back of the loan. But in either case, even though your credit score may not get affected, and there's some question around that because servicers aren't really designed right now for a forbearance package that doesn't impact your credit. But even if it doesn't mean that you're being waived from mortgage guidelines. So looking ahead, if you want to get a loan in 6 months, you might have a great credit score, but if you had a forbearance, you might be outside of the guidelines for a lender who decides, like Fannie or Freddie might come back and say, okay, if you had a job situation where your income was affected and you had a forbearance, maybe you have to wait 1 or 2 years to reestablish income. So that's something that people really have to be aware of. There's no such thing as a.
You can't make a $5,000 payment this month. You're definitely not going to be able to make a $20,000 payment 4 months.
Oh, we got a freeze.
You know?
There you go.
Potential issue is that you might be outside of guidelines when you want to go back to buy a house in 6 months when everything's okay.
Okay. So, the crystal ball question. Let's say you had planned on refinancing when markets or rates were really, really low.
Yeah.
You didn't take advantage of the 3%. Do you think now is still a good time to refinance, or do you think that when kind of some positivity returns to the market, there will be better rates?
So that really,
meaning that as investors.
Yeah, that really depends on your scenario. So conforming, we're right back where we were on March 6th. So loans up to $765,000, great rates available. If you're talking about a jumbo scenario, a lot's changed there. So, for example, a lot of our jumbo investors, no more cash out refinance, right? So they're not doing investment properties anymore. But if you want to do just a regular refinance, I do believe that low rates will come back to the jumbo market within the next, I'd say, 3 to 6 months. Between now and the election, let's say.
Okay.
That's my perspective.
And does the election usually have any impact on just not in the pandemic world, but in a normal world? Do election years have an impact?
They absolutely do. And now you throw a pandemic on top of it, and even more is at stake. And I think specifically in this election, we are more divided. And I hope that this really brings people together. What's happening right now, but we are more divided than ever. Everybody's in their camps. We are looking at two possible extreme scenarios of how you deal with the economy, how you govern, how you deal with social programs and things like that, taxation. So I can't sit here and say one is better or worse, but markets, depending on what you're looking at, are going to be very reactive to what happens in this election cycle, I think.
Yeah. So Marty just jumped in with a question wanting to know what the conforming and jumbo rates are today.
So if you have a great scenario, they're different for everybody, credit score, loan to value, et cetera, et cetera. But if you have a great scenario, we locked somebody today on a purchase with a $510,000 loan at 3.1%. We locked somebody at $765 today at 3.75%. So we're still below 4%, which is historically low. 15-year fixed pricing is at 3 or below. So the rates are really good right now.
And have you seen any change to the turn time on loans considering some of the hurdles with the COVID-19 pandemic?
Yeah, so there's a couple. Our internal systems are working pretty well in terms of our company functioning, right? Underwriting, docs, funding, all of those things are going really well. The outside things that we can't control, some of those are really becoming obstacles now. Appraisal was one right away, but then we got some relief from Fannie and Freddie and from some of the jumbo investors that you can do a drive-by appraisal. So now the question is, can we get an appraiser who's going to put themselves under the financial services umbrella because they're independent contractors? So the amount of appraisers who are willing to go out has gone down. So we've seen 3 to 7 day turn times balloon out to maybe 7 to 10 day turn times. Nothing's too severe, but a little bit slower. The other side of it is part of what I was talking about, that short-term funding facility where you fund loans. They're under severe pressure, so that funding process is taking a little bit longer. What used to take a day might take 3 days to a week all of a sudden. So, but I'm really lucky that I think in all of the transactions we're doing, we're closing a lot of loans right now, and all of the agents we're working with have been really kind, really forgiving. Everybody's really understanding of the situation. As long as they know that you're going to close, a couple of days extra hasn't really seemed to have been too much of a big deal.
Right. And have you, for recent appraisals that you've received, have you seen any adjustments to appraisals with appraisers kind of factoring in a shift in the market due to COVID-19?
I feel like it's kind of in the back of everybody's mind, but because they're looking in a rear view mirror, I haven't really seen it hit their pricing yet, right? So definitely moving forward, whatever sells today, like if there is a leveling off or a drop in prices or something, we'll start to see that reflected through the summer. But as of right now, they're looking at comps that sold in February, March, January, going backwards.
Okay. I'm going to open this up to some of the people on the live to see if anyone else has questions for Fairmars. We'll see. Do you have some other, while we wait for people to chime in, any other thoughts you want to add to kind of what's happening or what you see going forward?
Yeah, so I've seen, one interesting thing that I've seen is that, so I've got about 80 or so people who are pre-approved shoppers that have been in my pipeline since, they've been added, let's say, since January, right? Who've been actively added in the last 3 or 4 months. None of them, we check in with them all the time. We check in, how's it going? How are you guys doing? Nobody's dropped out, which is great. Nobody said, okay, I don't want to buy a house anymore. I changed my mind. There's some caution. There's some hesitation. It kind of makes me think that whenever we get out of this and things get lifted, that consumers will probably be not right back where they were. I think there's a lot of caution about spending money, not necessarily in real estate. Like they still want to buy a house, but maybe they're not going to decorate it and go crazy like they were. Or I've had a couple of clients who have pulled back from cash out refinance deals where they were going to pull a few $100,000 out and fix up their homes. They didn't want to get over leveraged and spend all that money right now. So the buyers are still there, but I think the consumer spending is going to be a little bit more tightened regardless of, whether we technically open up the economy or not.
Yeah, we've seen most of our buyers are hanging in there. We've had new buyers reach out in the last couple weeks.
Yeah.
They haven't really changed the desire to purchase on our end, but they've been pickier about where that money goes, right? That they're homes that don't have a lot of damage.
Yeah. Have you been getting a lot of questions about property values and where things might be going?
Yes and no. I mean, yeah, people are kind of waiting a little bit to see what happens. We're so new in the process. That's why I think if it's a home that has universal appeal and ticks all the boxes and is in great shape and a great location, they're still getting offers and they're still getting good sales prices considering what's happening. It's those outliers that maybe aren't ideally located or have a funky layout or have huge pest reports that are suddenly not so easy to sell.
Right.
Buyers aren't so open to that. But for the most part, there's been optimism. Hopefully it continues to trend that way. So we did just get a question from Nagar. What's the biggest hurdle you feel we will face in the coming weeks if we stay in this position? What do you mean, Nagar?
From a mortgage standpoint, I'll tell you, it's jumbo funding right now. The warehouse lending industry, which is the short-term money that's used to fund jumbo loans, has really freaked out, just like in 2008. And the cost of funds has become exceedingly high to fund a loan. Normally we fund a loan, a couple weeks later it gets, replenished when somebody buys the loan. The concern about large institutions purchasing loans that we've underwritten is now clouded over that warehouse funding area. So funding is right now currently our biggest challenge.
Okay. So we had this question, not sure if you already said this, but how are lenders reacting to mortgages, what's available to buyers? You kind of already talked about the fact that the conforming loan is still pretty on par with where it was.
Yeah.
And jumbos are getting tighter. For the ones that you closed recently with the relatively low rates for conforming, were there more points or more fees associated with those loans?
No, the pricing's great. And the Fed's pegging the price, which is interesting. So if you look at the price in the bond market compared to where rates are, if this was a normal market and prices were where they are now, the rates would be even lower. They'd be like 2.5%. But because the mortgage industry is pricing in so much risk, the Fed has bought so much. They're going to do whatever it takes to keep rates level where they are. That's why I don't know about rates getting any lower than where they are. Because if they do go lower, remember we're just funding out a record amount of refinances that were started in the last week of February and the first week of March. Those are all funding right now. The last thing the industry wants to see is 2.5% in June, where all those people go right back to the well and get out of their 3.25% that they just got. So that would be a disaster. So I think that is going to cause that not to happen. And, I think keeping rates steady, and given what happened, the wild swings we saw in the market, is what's healthy for the market. And that's basically what the Fed's doing. When there's not enough buyers, they step in. When there's too many, they step out. But they're basically leaving prices pretty much where they are.
Okay. I'm trying to follow these questions on the bottom here. Let's see. Marnie asked about the secondary market. Oops, sorry. Do you have anything to add on, because I know you guys rely on kind of the reselling or the servicing of the loan. Have you seen a change in the secondary market?
It's been crushed because servicing is a low margin business, right? Their job is to collect the monthly payment and advance the principal and some of the interest off to the investor. So in order to be a servicer, you have to agree to advance the interest portion of it, even if you don't collect the monthly payment from the borrower. So all of a sudden, this CARES Act gets passed, and they say nobody has to make a monthly payment, and that nobody talked to the servicers about it first. So they're all of a sudden in a position of having to advance billions of dollars that they're not collecting, and no relief has been put in place. And the head of federal housing has come out and literally said, we're not going to do anything for the servicers. Let's just figure it out and see if they go under, and if they do, we'll try to figure it out, which is like, why create a crisis and not fix it ahead of time? But that's kind of how they're treating it right now.
Wow. And so there's a Fed meeting coming up. Is it next week or in 2 weeks?
Yeah, it's in 2 weeks. And they postponed the March meeting because they did so much right before that meeting that there was no point in even having a meeting, right? They took rates to zero, intra-meeting. It'll be interesting. I don't know that there's much more they can do from a movement standpoint, like announcing any kind of new initiatives. They've done all of that. But what'll be interesting is their forecast moving forward. That'll be really a good indicator. There have been the Philadelphia Fed governors really, there's been some real sour outlook on what's going to happen. They were saying that, unemployment could reach 20% and that this could take a couple of years to get out of. So, looking at what their thoughts are around that will give us a good indicator as to where, rates and the markets and things like that will be going.
Okay. I think we already answered this. Holly asked if appraisals are taking longer, even with the drive-by. So are you seeing a longer turn time on those?
Not for us, but I have heard up to 3 weeks to 4 weeks potentially for the big banks. So I had someone who called me. They were really frustrated. It was an agent who I normally work with. We were talking about a separate deal, and they said that they've been waiting, 3 weeks for an appraiser to come, and they haven't even set the appointment yet.
Wow. Okay. Anyone have other questions for Fairmar? Fairmar, do you want to give some background on your history as a mortgage lender, who you work for, how people can get a hold of you, all that stuff?
Sure. So, I like most people, I never intended to be in this business growing up, but I ended up in it. So I've been doing this for 16 years. I was in technology, self-employed before that. I have always loved finance. I've always loved following markets. I love helping people, and that's really the core of why I do this job, is sharing information with people and expertise. It's a great thing. I've been in-house at Red Oak Realty for 11 years now, since the crisis, and that's been great. So it's been a really good relationship as well. And so I've done, in the last 10, 11 years, I've done about 2,500 transactions in Oakland and Berkeley, the East Bay. If anybody wants to get a hold of me, I'm fmz@bocm.com, or you can Instagram message me, or call me on my cell, 415-377-1147. Happy to answer any questions for anybody.
Awesome. So we've had a few people join just towards the end here. I want to wrap this up so we can all go to dinner. So if you had one final kind of overreaching point before we go, let us hear it.
I'd say hang in there. I'd say things are, I can't see them getting too much worse than this. I would, what's most important right now, and I'm hearing it on all these, multiple Zoom meetings I'm on, is it really is. It brings you back to what's important, right? You see people dying in hospitals in these horrible ways. If you have your health and if you have a roof over your head, I mean, these are things to really be thankful for right now. And the economy will come back and it'll all get going again. I know we're all getting frustrated. My kids have had enough of me. I can tell you that for sure.
Yeah, I'm not the best teacher.
Yeah, and I hear you. And I think I'm actually taking them backwards in their education. But I can't wait to get out and see people again. But we'll get through this together. And I just would say to everyone to hang in there.
Yeah. Thank you. And for those watching, we'll send out Fairmar's contact information. You can look for it on our MAJ Realtors Instagram page, or if you want to talk to him or reach out, and I'll share his information. So
thanks for having me. Great.
This is great. Thanks for doing this.
You got it.
Okay. Bye, everyone.